Hey, what's up, everybody? Real Talk Real Estate. This is the David Greene Show here with a live update for you on what's going on in the housing market, the U.S. economy, the war in the Middle East, a little bit about the tariff wars, and just what the hell is happening in the country right now. So many things are coming at us so quickly, you don't even know what to focus on. Should you pay attention to Israel and Iran? Should you pay attention to China? We used to talk about tariffs every day. Now we're not even talking about them hardly at all. Are interest rates going up? Are they going down? Is housing doing great or is it doing terrible? Do we still have inflation? Because nobody's talking about that anymore. And what's up with Russia? By the way, is AI going to take over everybody's jobs, or is it going to be our savior and fix anything? We're going to be talking about that and more, all of it, today on the David Greene Show Live. All right. Let me know as you guys are listening to this. You can comment on the show. And if you're listening to this after it's already been recorded, I do my best to go and reply to all the comments that people leave on the show. So please make sure you comment as you're listening. Also, before we get into our first video, just remember, I'm looking for questions to answer on the David Greene Show podcast. All you got to do is head to davidgreen24.com/ask, which I will put up in a second here. You can submit your questions there. Take a minute to subscribe to the show to get notified when we go live as we're listening. And let's get into the first video.
Be with you. It is such a busy morning. Obviously, we're continuing to watch what happens in the Middle East, but we also have a decision from the U.S. Federal Reserve today, and the market's going to be watching what the Fed has to say, not just about what they're seeing today, but where we go from here. It's such an uncertain time. Now, just as a reminder, the Fed is not expected to make a move on interest rates today, but let's say they were to walk back rate cut expectations. What would that mean? And of course, what is their view on the overall economic landscape in the U.S. when here in Canada, there are growing concerns about things like a recession? Carl Shimada tracks it all and what's happening in the currency market as well. He's chief market strategist at Corpay. Carl, it's good to see you.
You as well.
Okay, happy Fed Day.
To all those who celebrate.
Exactly. What do you think the U.S. Central Bank plans to say to the stock market today?
Right. I think they are going to stay very neutral, take a very wait and see posture in terms of the communications in the statement and what Powell says during the presser. But as you mentioned, the real crux of the matter is what they say about the future. And the statement of economic projections that gets released alongside the statement itself, that is going to be the thing that moves markets, right? And so basically markets at this point are waiting to see, does the Fed tell us that they're going to deliver 2 cuts later this year, as had been set out in the prior statement of economic projections, or are they going to adjust it to just 1 cut? And
This guy's got an interesting suit. It looks like his suit is trying to tune into a TV station, and all it's getting is that fuzz that shows up on the screen.
you know, that may be the case given that the window is sort of closing to continue easing, and that, you know, we have the threat of inflation coming from potentially the tariff increases, as well as the increase in the price of oil that we've seen in the last couple of weeks.
That was what I was going to ask you about. I think I just sort of jumped right to dessert before talking about, you know, digesting what the meal we're looking at is. Where is the U.S. economy right now, and where is the inflation issue?
That's the fun part. So right now we're looking at, you know, the data under the hood is pointing to a slowing in momentum, right? However, Fed official after Fed official has told us, you know, they're still looking at strength in the labor market. They're not totally convinced that all of the soft data from the consumer consumption end of things or business investment is going to translate into weakness in terms of actual growth, right? And so, you know, they're looking at all of that. They don't know which is, you know, whether we're going to see softness in terms of underlying activity or whether we're going to see a rebound in inflation. And so that's a big risk, given that, you know, we have seen an increase in inflation expectations among American consumers, largely tariff-led, but potentially we could have another leg higher here on the basis that gasoline prices are likely to rise a little bit, right?
Because oil prices are going up, or just because of summer demand, or both?
Both.
Yeah.
But, you know, it shouldn't be a major increase, but it is something that psychologically impacts expectations. And I'll say all of that before saying that at the same time, if we look at the U.S. personal consumption basket, the amount that households actually spend on energy, it's been going down over over decades, right? It is not a material input into the inflation process. What Fed officials are concerned about right now is the expectations avenue. They want to make sure that we do not have another rebound like we had immediately after the pandemic, in which consumers get sort of concerned about price increases coming down the pipe.
And we also move on story to story as fast as you move on TikTok video to TikTok video. I mean,
Indeed.
There's also the big, beautiful bill.
Right.
One could argue that the fiscal spending concerns are also something that the Fed has to consider for things like inflation as well.
I think so, but
it's longer term.
It's very long term, yeah. And it might impact, things like their estimate of neutral rate. But I don't think in the near term that's actually going to be a driver. It also, even in markets, seems to be a little overblown, right? We're talking a lot about it, but if you actually look at most of the metrics that influence where the dollar's at and where treasury yields are at, those are being driven by a reassessment of U.S. growth characteristics.
I do want to tie in Canada in just a second.
Sure.
We spoke to Fitch's head of U.S. economic research earlier today, and he talked about the possibility of a Fed shadow president. The idea that Donald Trump, who never shies away from commenting on Fed strategy or even his views on the Fed chair himself,
right?
Let's not be surprised if there's some commentary from the president on whatever the Fed says today, but also the possibility that you could see a successor to Jay Powell named before Powell has actually left the job, and whether or not that's somebody who's going to be commenting. What does that dynamic, the political dynamic in the U.S., where typically we don't really see a lot of noise around what the Fed is actually doing from the White House, what does that mean, do you think, for how markets have to interpret all this stuff?
I think it should be taken off the table largely. I don't
discount it. Markets should discount it.
Markets should discount it, at least in the near term. Like, there is the possibility that when Powell leaves, he's replaced by a more dovish candidate, and that should influence longer term bond yields. But in the near term, as far as we're looking at any given decision, the reality here is that this is a institution that is well insulated from political pressure. It is staffed by people who, have a devotion to the job and to the data, as opposed to, listening to all of the noise, including Powell himself. And so I don't think that we're going to see, those decisions shifting on the basis of pressure from the White House in the near term.
Okay. And then as for the Canadian story, obviously, many would make the argument that we're in a much weaker spot and we're still navigating trade uncertainty. And, I think that the Bank of Canada has said they're still concerned about certain kinds of inflation as well.
Right.
But we also alluded to the fact that the minutes from the June meeting were indicating a cautious tone. So how would you characterize where Canada's economy is right now?
Yeah, so I think, the Canadian economy is clearly losing momentum and has lost momentum from the beginning of the year.
Yeah.
Trade shocks have hit it very hard, but there is a lot of uncertainty. And so firstly, if we look at what the Bank of Canada said yesterday, the Bank of Canada is saying, we are going to look through tariff-led price increases. We don't think that those reflect long-term inflation pressures. We think that the economy needs further easing. There was a lot of discussion about cutting rates again. That has put, rates in Canada under pressure.
Mm-hmm.
And then at the same time, we have all of these sort of positive attributes. The fact that Canada is running a lower tariff regime than other major countries relative to the US. The fact that we have fiscal spending coming in, and most powerfully, perhaps, the fact that the Bank of Canada eased rates so much last year that the lagging impact of that is hitting, the Canadian household sector and the economy more broadly. So the challenge that we have right now is, if we can get through sort of a soft spot, perhaps we come out a little bit stronger than had been anticipated, and the Canadian dollar may prove to have been undervalued for a while here.
So that was going to be my final quick question here. So the loonie has enjoyed some momentum against the U.S. dollar.
Yes.
Based on what you're saying, you think that could feasibly hold?
It could hold, yeah. There is a bit of big contradiction going on right now, right? So the yield differential between Canada and the U.S. currently points to the Canadian dollar being quite overvalued. The fact is that rates in the States have stayed high and are not looking at coming down anytime too quickly. And so the Canadian dollar has rallied past that and sort of outperformed where that rate differential is. But on a longer term basis, if we look at the gap between Canadian and U.S. unemployment rates, that has widened slightly, but the Canadian dollar is essentially in line with where it should be on a long-term basis. And I should point out there, or give credit there, Doug Porter from BMO originally pointed out that relationship, but it is like the most accurate long-term predictor of where the Canadian dollar goes. What is the difference between US and Canadian unemployment rates? And so right now, that suggests that we're very close to fair value, meaning that it'll be very difficult to break out of the range that we're in right now.
All right. If you're wondering why we're talking about the dollar so often, it's because the value of real estate is tied very closely to the value of the dollar. When we print more dollars, they become worth less. Real estate values go up. When we have a strong dollar, the U.S. economy is solid, and the likelihood of real estate values going down and jobs going away goes lower. When we have a weak dollar, we have the opposite problem. Also, many real estate investors think about the value of the property, but they don't always think about how likely their tenants are to pay rent. I think this is something people should be paying attention to a lot more now than what we had to in the past. When the economy is rock solid, you don't worry about vacancy. You don't worry about economic vacancy, which is the phrase that we use for someone who's living in your property, but they're not paying anything, and you may have to pay to evict them. And we don't worry nearly as often about if the tenant you are picking is going to be able to pay the rent. Well, if the U.S. economy goes bad, the dollar goes poor, and the job market goes bad, you may be good, but that doesn't mean your tenants will be. And you may have a lot of vacancy, and you think you're good because you have a job, but all your money is getting lost because your tenants can't pay their rent, and you still got to pay that mortgage. So I think investors should be talking about this a lot more. I'm probably a little ahead of the curve. I'm talking about where we're going, where some of the other influencers are talking about where we are. I like to try to warn people for what's coming. I think you need to be very concerned about what's going on with the economy and if your tenants are going to be able to pay their rent so you can make your mortgage. All right, let's see what the Fed Chair Jerome Powell has to say about the U.S. economy. We just heard that news previously. We'll get a little different perspective here.
Uncertainty has come down. The economy is moving at a solid pace. Inflation has come down over the past 3 months. And this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. And what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional,
All right, let me help you read between the lines here a little bit. The reason Powell is talking about tariff inflation is because President Trump is trying to get tariffs from other countries or put on other countries so the U.S. can create more revenue. And if the companies that have to pay a tariff pass that cost on to the American consumer, which they don't have to, but they likely will if they can get away with it, that will make things more expensive. And Powell's position here, what's not being said is if Trump does that, I will use that as an excuse to keep rates high because I have to keep rates high in order to keep prices from going up too much. I don't see the logic in it. I mean, I can understand his logic. I just don't think it's practical because if you're facing things becoming more expensive, you want debt to be cheaper. You want to give people a break in how much they're paying on their credit card bills, how much they're paying on their house mortgages, how much they're paying on any kind of revolving debt that they may have, how much it costs to buy a car. It would actually give people some relief in that things could be cheaper for them. His argument, I'm sure, his perspective, and this is a lot of people's perspective, is if you raise rates, you stop prices from going up. If you lower rates, prices will go up. I don't know that I agree with it all the time. It is obviously true in many cases, but it's not as simple as this is the way it works. It's set in stone. If you have high rates, but you have tariffs and companies pass the cost of the product and the tariff they paid onto the consumer, it doesn't matter where rates are. If you're claiming tariffs make prices go up, you're not stopping that by keeping rates high. What I think we're hearing here is Powell saying by the word tariff, that's a dog whistle for Trump. He wants tariffs. I'm going to use that as an excuse to keep rates high.
Forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer.
Does somebody have to pay for them? Could companies just take a lower profit? Could they increase the price a little bit, but decrease their cost by laying people off because we have AI? Are companies about to save a whole bunch of money in labor because they're laying people off and replacing them with AI, but not telling us they did that and saying, well, I have no other option. I have to raise prices because there's a tariff. But meanwhile, they're saving money in other places.
Ultimately, somebody putting it into a good of some kind, or just the consumer buying it, and all through that chain, people will be trying not to be the ones who pick up the cost. But ultimately, the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming. And we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again. Right. So it's always forward looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad. Right. So we took very aggressive forward looking because we knew things were going to be unusual.
Side note, let me know in the comments. Do you think Jerome Powell could play a Keebler elf in a live action movie about the Keebler elves, the world they live in, and the delicious butter cookies that they make?
Usually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment. You talk to business people now, there's a very different feeling now that people are working their way through this. And they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So, again, we think that our current stance of monetary policy is in a good place.
That sounds like the same thing that we've been hearing every single time that Powell talks. We're in a good place. We don't need to change anything. We're going to hold the line. We're going to keep rates high. Meanwhile, housing is getting decimated right now because nobody will sell their house. If you have a 3.5% rate, a 4% rate, a 3% rate, you don't want to sell to someone because you're going to have to go buy the same house at roughly the same price for a 7.5% rate. And if you're looking to buy a house, you're like, well, I have to pay 7.5% and the price is roughly the same, but insurance is 2 to 3 times as expensive as what it used to be. And maintenance is 2 to 3 times as expensive as it used to be. And materials, same story. And so what we have is people that own houses are roughly okay, other than insurance and maintenance going up, but nobody can afford to buy one. And nobody's putting them on the market to sell. And so not only is it hard for people to buy a house and nobody wants to sell a house, but all the people that make money from houses, which is a huge part of the economy, they're not making any money either. All the realtors are struggling. The brokerages are struggling. The loan officers are struggling. The loan brokerages are struggling. The title and escrow officers are struggling. The photographers, the landscapers, the people that do home inspections, the home warranty companies. Think about everyone in your life that works in real estate in some way. Construction people, home remodeling people. None of them are making money when houses aren't trading hands. When everyone just hoards what they've got and they circle the wagons, money stops changing hands. That means human beings are making less money. They're getting more scared. And it also means that the government is bringing less money in revenue, which of course increases our debt. This is a big problem. And I don't know why I feel like I'm the only one mentioning this component of it. A lot of people are talking about rates up are good, rates down are bad. And they're just saying we have to raise rates to stop inflation. But they're measuring inflation differently than people like me look at it. I look at it like, how many dollars have we created? You're not taking them out of the market very well. So inflation isn't going away. The toothpaste is out of the tube. You can't put it back in very easily. Why don't we focus on helping people make more money and keep more of it with lower taxes? So even though you can't push prices back down, you can push income up higher. And so you're not devastated by the increasing costs, right? Like if we can't stop insurance from coming down and materials from coming down and tariffs making things more expensive, why don't we go on offense? Why don't we have politicians that are coming forward and saying, hey, we can't stop them on defense, so let's score more points. Let's get a bunch of Americans out there hustling and bustling and making things happen instead of the constant, you got to save, you got to circle the wagons, you got to tighten up, you got to pull everything in together. And then we all just sit here watching YouTube to see what form of doom is going to hit us today. Let me know in the comments what you guys think about my opinion there. We got Turns TS Nako says, let's go Florida Panthers. You got Alley Cat says, I think old Jerome Powell may be concerned like with President Hoover. However, aggressive tariffs will lead to a global trade economy, a global trade war, and worsen the economy. Jennifer Roof, I've done several live-in flips previously. Did you repair the roof, Jennifer? In March, I bought my first secondary property to fix and flip. Very concerned about selling it. Should I shift strategies to a rental? You might have to. You might not have an option, especially if you're in Florida, I believe. Did you say that, or am I just thinking that? Florida's in my head for some reason when you said it. If you are in that area, you may have to keep it as a rental. I would try to sell it, and if it didn't sell right away, I'd put it up for rent, and I'd let it rent and leave it up for sale. Whichever one comes first, an offer or a tenant, I'd go that route. Jennifer also says, he looks like an evil elf. You guys remember Will Ferrell and Elf? Ooh, he's an angry elf. Call me elf one more time. I think of that every single time I see Jerome Powell. Devin Figuth, do you feel Ray Dalio is right within all this, or is there a way out? Which steps are best to prepare? Such a great question. Let me get to that later in the video. It's bad. It's bad. It is way worse than everybody thinks. Like, I don't know why I feel this way. I mean, I could try to articulate it for you, but there's like an algorithm in my head where I could just feel this stuff. And this is why I'm going live so much, talking to everybody. There's a lot of people that are like, oh, it could be bad. No, I'm saying this is Lord of the Rings. We are at Helm's Deep. We have an army of orcs that are marching towards us to destroy our wealth. And Americans are worried about like what beer we're going to serve at dinner tonight. We are so caught up in stupid, trivial things that are not going to matter at all. If what hits us, like I'm afraid it's going to hit us. And I just hope some people out there will wake up and take serious steps to prepare, because I think it's going to be really bad. Jennifer says, this is in North Carolina. You're in a much more solid market than most people are. I like the Carolinas quite a bit. And Turns T Nako says, South Pole elf. All right, let's get to our next video. Keep the comments coming, everybody. I'll keep sharing them.
Former Treasury official and Morning Joe economic analyst Steve Ratner. Steve, there has indeed been plenty of speculation about how Trump's tariffs will impact the country. So tell us, how does the economy look almost 5 months into Trump's second term?
Yeah, it's interesting, Jonathan. I think all of us predicted that inflation would start to go up as a result of those tariffs. But yesterday, there was a report that, in fact, it has really not yet gone up, or at least not yet gone up. So the Commerce Department reported that prices for all goods went up by 2.4%. I should say Labor Department, 2.4%. But for what we call core goods, which is you take out energy and other volatile categories like food, they went up 2.8%. And that, as you can see, is flat here and just slightly up here. So pretty good news on inflation. Why? I think people feel there are three reasons why we haven't seen the tariffs yet. First of all, importers stocked up in anticipation of those tariffs. Secondly, businesses are trying hard not to raise prices, although at some point I think we expect them to. And thirdly, the tariffs have been on and off and paused and so on. And so the effective tariff rate is actually at the moment a good bit lower than what Trump had put in place at the beginning. But economists still expect them to rise by about 3% this year, which means faster than that at the end of the year. And consumers actually expect them to go up 6.5%. Trump, as you know, has been posting on social media about how the Fed has to cut interest rates. The Fed has to cut interest rates. The Fed's target is 2%. They use a slightly different price index, but close enough. 2% is what the Fed wants to cut interest rates. So there's a tug of war going on right now between Trump and Jerome Powell, the head of the Fed. But let's look at another indication of what impact the tariffs may have this year. The World Bank, completely dispassionate, a neutral organization, put out its semi-annual forecast day before yesterday. And what did they do? They took down growth estimates for the U.S. pretty substantially. They had been projecting back in January 2.3%. Now they're down at 1.4%. It is more than worth noting that 1.4% is exactly half of the 2.8% that we achieved in the last year of the Biden administration. So the president who promised to, quote, revitalize the American economy is actually looking at a growth rate of half of what it was last year. And then the other noteworthy point is we may well be shooting ourselves in the foot because the World Bank only took down its estimates for Europe's growth rate, which is slower than ours, but they took it down by a much smaller share. And they didn't change China's growth rate at all. So they feel that China is going to work its way through these tariffs a lot better than we are.
That's such an important point about growth rate. We'll have more to say about tariffs in just a moment as we read from a Wall Street Journal editorial board take about Trump's tariff policy towards China, or lack thereof, really. So, Steve, let's move now to chart 2. Labor market slowing down.
Yeah, so we had an unemployment report last Friday, and the good news is the economy added a lot of jobs. The bad news is that the growth rate in jobs have been decelerating. Now, some of this was inevitable. This is out as we were coming out of COVID. This is a very, very high number of jobs that we were adding. And so it's natural that it would have come down. But now for the last several months, the number of jobs we're adding is actually below. This is the pre-pandemic average. So this is a kind of normal, stable economy, what we were adding. And this is what we've been adding over the last 12 months. There's one other interesting point about this, which is not on here, which is that 600,000 people dropped out of the labor force last month. That is a very big number. We don't know who they are. I don't know who they are, but it's not out of the question. This may have something to do with Trump's immigration policies. But consumers also have noticed the fact that the job market is weakening. If you look at the percentage who think jobs are plentiful, it's dropped to 32%. It was up here close to 60% as we came out of COVID. That's also obviously unnaturally high. But if you look even before COVID, the number of people who thought they were plentiful was about 45%. The people who think not so plentiful, obviously rising. And the people who say hard to get, 19%, also well above pre-COVID levels.
And Steve, another indicator of this economic uncertainty that just seems so pervasive is your third chart. Home buyers simply aren't biting.
Yeah, I think when you talk about those poll numbers you were showing earlier, things like the situation with jobs and then with houses play a factor in all this. So what's happened? It's really interesting because the number, again, coming out of COVID, ignore all these wild fluctuations, but coming out of COVID, the number of buyers, the number of sellers was kind of in balance. Now look what's happened. The number of sellers has shot up to almost 2 million. The number of buyers has dropped to 1.5 million. And so you've got almost 500,000 houses sitting on the market waiting for buyers. Now, why has that happened? Some of it is clearly economic uncertainty. Again, you go back to the Trump economic policies, up, down, backwards, sideways. People do not want to make major purchases when they really have no idea where the country is going. So that's a factor. But the other factor is that what we call affordability, what an average consumer has to pay to afford his house, has been rising for a good while since we started raising interest rates coming out of COVID. So back here in 21, it was $1,000. Today, it's about $2,000. And so that is a significant impact on consumers. But Trump, who again came to office promising he was going to solve all these kinds of problems, what's happened? Since Election Day, it's gone from $2,100 up to almost $2,200. And on Liberation Day, it actually took a particularly large jump because the 30-year Treasury took a particularly large jump because of the tariffs. So we're going in the wrong direction on housing affordability at the moment, as well as consumers' willingness to make major purchases as we live in this world of economic uncertainty.
Yeah, lots of warning signs there. So,
yeah, they hit it right on the head there that affordability is the problem. It's crazy that we can see a video that basically spells out the obvious, but the guy leading the Fed is still over there saying, no, we're just going to keep rates high. And I also wonder, why can't we get anybody in the White House to look at some ways of getting mortgage rates low, even if we keep interest rates higher? What are some creative ways that we can do that, at least for a period of time, to get things moving again, and maybe keep interest rates higher when it comes to consumer debt, revolving debt, credit card debt, student loan debt, car debt. But housing, we need to get it. And it doesn't need to be lower inherently to be lower. It only needs to be lower because it's sort of like that's where they got buried in the ground and at a low rate, and we started dumping dirt on top of it. And now we're all trying to buy houses way too high, and all the inventory is stuck down here. You got to get down to wherever it was and then bring them both up slowly. Let all these houses that have really low, not all of them, but a lot of them that have really low rates, trade at a slightly higher rate. They sell at 3%, they go to someone at 4%. Then they sell at 4%, they go to someone at 5%. And you get kind of the whole market coming up a little bit. And then if every house is at 7%, you don't get this log jam of inventory where nobody wants to sell. Like, that's at least what my mind sees. We don't have to keep them low forever. That just creates another problem, because then when you raise them, you have the same issue. You just have to get them low and then incrementally raise them very slowly, as opposed to what we did, which was super stupid, which was raise them really fast, really high, all at the same time. Jennifer says, I would love to see statistics on how many deported were holding labor jobs and how many were involved in illegal ways to earn money so they didn't need a job. Mike Smolligan, really good realtor in Michigan, says, my market over here in West Michigan is somewhat in a bubble as home sales are too far down compared to last year. I've had a few people, though, rolled off on selling because of interest rates. Solid point there. Keep the comments coming, everybody. All right, let's talk about the war.
The world that many people, many listeners might not be familiar with, but economically speaking, it's extremely important, isn't it?
It is. And what's happening there, Lewis, is a bad shock for the global economy at a fragile time. It will slow economic growth. It will increase inflationary pressures. It will reduce the scope for policy, including in the UK, and it undermines the global order. So whichever way you look at it, the direction of the impact is clear. The magnitude will depend on the duration of this conflict.
In terms of, people talk a lot about the Straits of Hormuz. This is an area of the world that, in terms of international shipping and oil in particular, is very important. If those straits were to be closed, which is something that there's been speculation about, what kind of impact do you think that could have?
Well, first, we've seen the impact. Shipping lines have now reduced or stopped their use of the straits, and for understandable reasons that become more dangerous. That impacts the supply of oil to the rest of the world. That impacts the oil price. It impacts what we will pay at the pump. So we're already seeing the impact. If they are indeed closed, then that impact will multiply in a significant manner.
In terms of overall economic volatility at the moment, it feels as if there are so many hotspots around the world. It makes it extremely difficult, doesn't it? For any finance minister, our own, of course, is Rachel Reeves. She's going through the comprehensive spending review at the moment, what happened this week. These are figures that are predicated on, forecasts for years to come. It almost makes the entire thing feel quite futile, doesn't it? The geopolitical volatility of the world right now.
It does. And we've seen two different reactions. In the case of the government, they're sticking with one central scenario, and they just keep on revising it. But if you go to business, they are now looking at multiple scenarios. Most businesses now are having to discuss not only a baseline, in fact, they can't even define a baseline. They're defining many possible outcomes. And the result of that, unfortunately, Lewis, is that people tend to go to the sideline. They wait on investment decisions. They wait on employment decisions.
If, of course, this goes on for any length of time, we were hearing from Richard Dearlove, who thinks it will go on at least for a few weeks. If it were to go on for longer, and we did see that inflationary pressure start to build in the economy because of disruption to international shipping, it makes it even less likely, doesn't it, that we might see monetary policy easing, i.e. interest rate cuts over the course of the rest of the year, which is something that many politicians, Donald Trump certainly wants, but also Keir Starmer would quite like as well.
You're absolutely right. It pulls the rug from policymaking because it's stagflationary. That's a really important word, Lewis. Stag means it slows the economy. Inflation means it increases the price rises. So a central bank in that context will be less able to cut interest rates, but let's also not forget the budget.
I need to know what kind of accent this is. This sounds to me like the French race car driver in Talladega Nights. Is anybody else picking up on that? Say you love crepes. That's what I'm hearing. So there's, he's describing stagflation, which is like your economic doomsday, worst case scenario. You've got inflation, which is where prices go up, but it's usually accompanied with jobs going up. So unemployment is low, which is good. Then you've got, I don't know what you call it, deflation, where supposedly prices are going down, but you're having more unemployment, and that's what's leading to prices going down. So there's less jobs. That's bad. In each case, you have something good mixed with something bad. And because the Fed's job is to balance those two things, unemployment with prices, they're usually like, oh, this one's getting bad. Let's tweak the rate. And it goes over here. Now we got to adjust again. And they just kind of play this game all the time because they mostly only play with interest rates. Stagflation is where you get the worst of both worlds. It's where you have unemployment happening, there's stagnation in the economy, and you have inflation happening. So prices are going up and we're losing jobs. That's the doom spiral. That's what you're trying to avoid. That's where the rich people are the only ones who are okay, and then they get to soak up all the assets because the poor and the middle class are losing them because they're losing their jobs and they can't afford stuff. That's where more wealth transfers to wealthy people. That's what we're all trying to avoid. And so when he's referring to stagflation, he's saying this is what these countries are hoping don't happen.
The budget gets hit on both sides.
Did I just say hoping instead of hoping? This is what happens when you record live. Things like that make their way into the show.
Lower revenues and higher expenditures, which means come October, there's a higher probability of greater taxation.
How concerned do you think the Chancellor should be that of the G7 countries currently, and these things fluctuate a bit, but currently Britain's borrowing costs are higher than any of our G7 competitors?
They are, and they reflect a few things, including the lack of the European Central Bank support, including Britain's own debt dynamics. Look, the Chancellor should be worried. Her room for maneuver, her so-called headspace, is getting reduced day in and day out.
How worried do you think she should be? Do you think there is any prospect that as the year goes on and some of this volatility we see becomes more acute? I mean, there is often some, fevered talk about Britain facing a debt crisis. Do you think that is, if not a likely outcome, it's a credible outcome?
I say it's a possibility and not a probability. It becomes a probability if the government decides to borrow its way out of its new problems. Now, that's not good news for anybody listening, because the alternative to borrowing is either higher taxation or lower spending on public services. So whichever way you look at it, this is going to hit us in the pocket.
Mohammed, I'm right in saying you're standing for Chancellor of Cambridge University, am I right?
I am.
Do you think, just on an entirely separate question then, do you think that Britain, in that new role that you might have, given what we're seeing in higher education policy from the Trump administration and the fact that there are many people working, academics, very, very gifted people in the United States who are worried about the war, really, that at least against some institutions the Trump administration is waging, do you think we in Britain should be welcoming these people with open arms?
So they certainly want to come. We're seeing a number of students who would have gone to the US now looking to come to Cambridge. We're seeing a number of academics from the US, brilliant minds, Lewis, who would like to come here. The reality is our ability to absorb them is less than our willingness, and for long-standing reasons. Some have to do with the context, visas, but others have to do with our financial capabilities. These people need accommodation. They need support. So one of the reasons why I'm running is to try to make Cambridge more resilient, more agile, so that it can maintain its academic excellence, it can protect freedom of speech and academic freedom, and it can welcome brilliant minds who contribute to the well-being of this country and the world.
Just very briefly, what is one thing you think the British government could do to do exactly what you've just said, to allow more people to be able to come? Because it is potentially a tremendous economic opportunity, isn't it?
It is a huge opportunity. Follow what the French and what the Swiss are doing already. They have moved very quickly to make it easier for these people to come on a temporary basis. I want to stress a temporary basis in order to contribute to the economic well-being. Most of them want to go back to the US. They don't want to stay here. They want to go back to the US, but they'd like a 2 to 3 year place, which is safe and which allows them to continue to do the brilliant things they do, which results in massive innovations and higher income for quite a few people.
Mohammed Al-Arian there, president of Queen's College, Cambridge, also standing to be Chancellor of Cambridge University.
All right, there we go. More talk of what everybody is worried about. Like, it's not just me. There's quite a few people that are concerned about the economy right now, and it's not getting a lot of attention, mostly because everybody's talking about the war or the tariffs or elections or the riots, right? They're not talking about the fact that the money is in a bad position. Mike Smulligan also said, as a real estate agent, I've had a few people hold off due to interest rate hikes, but I feel like we're relatively close to the same months of inventory as we were this time last year. And Texas Forever says, David, where do you park your cash when waiting for a new deal? Do you buy short-term bonds, high-yield savings accounts, etc.? No, I park it right in the bank. Mostly because I constantly need money for paying people's salaries and marketing budgets and mortgages and repairs. You have as many rentals as I do. Stuff breaks constantly. You're always having to put money into it. And in markets like now, nobody's really renting them. The long-term rentals are doing okay, but your cash flow is getting eaten up by rising expenses. And your short-term rentals in most markets are getting hammered. And you can't sell them because nobody wants to buy them when they're getting hammered. And it's tough to make money in the world of real estate right now because housing transactions are not happening. And then you go, okay, well, what could you start a business in? That's a great question. What's thriving right now, folks? You tell me, where do we see all of the labor and the money and the attention going? What market is everybody flooding into? A lot of people are trying to leave the jobs they've got. They want a better one. What better jobs are out there right now? It's sort of crickets. Like, we're not being given any options of what we can do to improve our situation. Even if you're willing to work, where do you go to work? And when's the last time you guys saw somebody get a raise? There's not a lot of money to be given for raises. And if you own a company, when's the last time you had an employee that came to you and said, hey, I want a raise. What do I have to do to make more money? How can I do more, bring more value to make this company thrive so I can get paid more? That's pretty rare. I don't know any business owners that are telling me they got that problem. It's mostly people saying, how can I work from home? How can I make my life easier? How can I get paid more money, but get responsibilities off of me? How can I get AI to do my job for me so I don't have to do it? So you're sort of like at every single angle right now, economically struggling. Dollars are becoming worth less. Real estate prices are going down. Rents aren't going up, but expenses are going up. I guess the stock market's doing okay, but who knows how long that's going to last, because when AI comes in, a lot of these like tech companies are just going to go under. They're going to be replaced by AI. You're probably going to get a lot of wealth conglomerated into a small percentage of companies that won the AI race, and then all the other ones go away. I don't know what the options are, but I know we need something. So hopefully somebody can get this in front of somebody that's in an influential position and actually asking questions like, how do we bring jobs back to America? And how do we lower expectations from our own labor force of what they think they deserve, right? You got a lot of people that were like, screw it, I don't want to work for the man. I'll just go Uber. Okay, well, what are you going to do when Waymo or Tesla takes over your job and you can't Uber anymore because we don't need you to drive a car. The car drives itself. You're going to go DoorDash? Nope. They're probably just going to stick the pizza box in the car and send it off to the house. And the person's going to walk out and take the pizza box right out of the car. And maybe they start putting like microwaves or heat ovens into cars to keep the food warm when it gets there. Like, we have so many crazy things that are going to be changing. And it's not like nobody wants to work in our country. There are people that want to. They need some direction of where to go. And the people that don't, they need a swift kick in the rear to get them out of this, because we're competing with other countries that have people that do want to work. And we had it good for so long. And we talked about this a lot on various different podcasts about why real estate was great. And for years I said, don't quit your job unless you have a really good opportunity to make money in real estate. And now you see why I was saying that. I don't want families going hungry because people got greedy and quit their jobs and didn't want to work. And I don't want to see people lose their real estate. So please make sure you're keeping your money in reserves. You're living beneath your means. Check out my book, Pillars of Wealth, to learn about how to play defense with your money, and continue watching for more content on updates and news content that's going on in the world. You don't have time to watch it yourself. Follow me. I'll put it together for you and I'll break it down so you can follow what's going on in the world, in the war, and in the economy as well as with real estate. If you guys would like to finance real estate, I gotcha. The One Brokerage is here for you. Send me a DM on Instagram. I am at David Greene 24. If you'd like to stay in one of the properties that my property management company manages, you can also follow us at CTC, like Coast to Coast Getaways, and let me know that you're a subscriber of the show and you'd like a discount. And if you've got a property that you're looking for somebody else to manage so you could put your attention towards something else, we're taking on new short-term rentals. So let me know. Please subscribe to the show to get notified whenever I go live, and I'll see you guys soon.